Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E6-19 from the workbook. So let's assume dollar value stores estimates its inventory by the gross margin method when preparing monthly financial statements. It uses the periodic method otherwise. For the past 2 years, the cost of goods purchased has averaged 60% of net sales, and assume further that the company's inventory records for the store are revealing the following data. Okay, so they have inventory of $480,000 worth on June 1st, 2020, and we have a purchase and sales transaction throughout June. So what's required here? Estimate the June 30th, 2020 inventory using the gross margin method. Okay, I'm just going to highlight that. We're going to use the gross margin method. Okay, so let's just think intuitively here what we would do if we had perfect information. If we had perfect information, we would take our beginning inventory and we would add to that our net purchases. What did we buy throughout the year? When we add these two together, what we're given is the cost of goods available for sale. This is what we could sell to customers. So what we had plus what we bought is what we could sell to customers. If we then deduct from it the cost of goods sold, we would arrive at what would be ending inventory. Just thinking about this intuitively, it makes sense. What we had plus what we bought is what we could sell to customers, minus cost of goods sold, remembering that cost of goods sold represents inventory we used to have. We're going to arrive at what ending inventory is. So I'm just going to start by populating what's given to us in the question into this template here. I'm not going to be able to solve it. I'm going to have to do another step, but we'll cross that bridge once we get there. So our beginning inventory was given in the question. That's June 1st, 2020. We had inventory of 480,000. So I'm going to take this and add it as the beginning inventory balance here. And what else? Cost of goods available for, or net purchases, sorry. What did we buy? Well, this company assumed dollar value. They bought $4.9 million worth of inventory throughout the period. So that's the net purchases. So when we add those two together, what we had plus what we bought, that's going to be what we could sell, or what dollar value stores could sell to customers, right? And that just makes sense. Well, what did they have? They already had $480,000 worth of inventory in their storage room or their warehouse, and they put another $4.9 million worth of inventory in their warehouse, which means the value of inventory in their warehouse is $5.4 million, and they could sell that now to customers. Now, we've used this, we don't need it anymore, and we've used this, we don't need it anymore. And what we need to do, or what we need to calculate, is what the cost of goods sold was in order to figure out what ending inventory is. In the question, it tells us for the past 2 years, cost of goods purchased has averaged 60% of net sales. And we're given net sales here. So I'm just going to type net sales, cost of goods sold, and gross margin, just to get a little template for us set up. We know cost of goods sold, or sorry, sales is $8.3 million. Then it tells us in the question, the cost of goods purchased has averaged 60% of net sales. So in this formula here, I'm going to type 60% multiplied by net sales. So when I deduct these two, deduct cost of goods sold from the net sales, I get gross margin of 3.34 million. And this is getting a little bit messy and convoluted, so I'm just going to erase all my markup. But before I go on, I do want to talk about the 60%. Knowing that gross margin is sales minus cost of goods sold, and cost of goods sold is 60% of sales, if I were to add these two together, it would equal the full 8.3. Therefore, the gross margin percent here is going to be 40% of net sales. And that's because gross margin plus cost of goods sold has to equal net sales. And if cost of goods sold is 40% of sales, 60% of sales, sorry, gross margin has to be 40%. Okay. I'm just going to give us a clean sheet here to work with. Okay. So we calculated cost of goods sold at 5,016,000, which means that ending inventory has to be 384,000. This is good. We've solved requirement 1. However, I did this in 2 steps. One where I calculated cost of goods sold separately, and then I added that here on the left. This could be done in a single step. I'm going to show you how to do that just below. It's going to start off the same way, just like we did with beginning inventory. We add in net purchases to calculate what the cost of goods available for sale is. Then we have this little subsection within this to calculate cost of goods sold directly within the template. Sales revenue to do that, and less the estimated gross margin to get the estimated goods sold. And of course, the result of all of that is going to be the estimated ending inventory. Okay, so the beginning inventory doesn't change. It's still the 480,000, and the net purchases doesn't change. It's still the $4.9 million. When you add what you had plus what you bought, the 5.4 million is what you could sell to customers. Now, to make our template a little bit cleaner, I should put this over here, so my apologies about that. Now, sales revenue tells us in the question was $8.3 million. The estimated gross margin, remembering that gross margin plus cost of goods sold is going to equal net sales. So if we're given cost of goods sold has averaged 60%, gross margin has to be 40%, because these two together have to be 100% of sales. So the estimated gross margin is sales multiplied by 40%. Therefore, the estimated cost of goods sold is going to be sales minus gross margin at $5.016 million. Therefore, ending inventory is 384,000. Does it match what we did above? Here, in fact, it does. So we know that both methods we did are correct. Now, bear with me a minute while I'm going to erase this template just to remove all of the markup so we can proceed. Okay, I'll get rid of that. Completely done with requirement 1. Requirement 2 says prepare the June income statement through the gross margin for dollar value store. So what this is meaning is just we know, well, the income statement discloses revenues minus expenses to calculate net income. In the multi-step income statement, we calculate gross margin first before deducting operational expenditures. Where it says through gross margin, that just means from revenue until you get to gross margin. We don't have the operational expenditures here to deduct, so it's going to be a partial income statement. So I'm going to do this right here. And we should also know that in order to do any external facing financial document, so any financial statement, we should start with 3 title lines. So here, this is dollar value store. That's the first line. The second line is going to be, well, what income statement is it? So, or which financial statement is it? This is the income statement, and it's a partial income statement because we're only going to do it until we get to gross margin, and we need to know the time period. So this is for the month ended June 2020. So to start off our income statement, it always is going to start with your revenue amounts. So sales revenue, we're given sales revenue of 8.3 million. Again, indicating in the top row the functional currency of the financial statement, so measured in dollars. Then we disclose what cost of goods sold is. We calculated that, well, in several different places, but here, calculated cost of goods sold was $5.016 million to arrive at gross margin. Sales minus cost of goods sold, $3.344 million. And now we're done with requirement number 2, preparing a partial income statement. So we'll put an X by it, and we're done with this problem. So if there's any questions about it, feel free to reach out to me or to any of your instructors. I'd be happy to help you as you go through this online journey with us. Otherwise, this was E6-19 from the workbook. I hope you found this helpful. My name is Kyle. Have a great day.